Hey everyone, welcome to today's show. My guest is Trevor Neil from the Betagroup, joining us from London to give us a take on the on a more European perspective to what's happening with global equity markets, particularly in the U.S. And today had a bit more distribution. Yesterday, I mentioned we changed the background of the show to highlight the to reflect the daily activity. We were green yesterday. We be more red today. We're going to break down all the movements and see what today's sell-off means relative to the big picture trend. Ladies and gentlemen, this is the final bar. Hello, everyone, and welcome to today's show, The Final Bar. Thanks so much for joining us. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Really appreciate you coming along this daily journey with us, looking at the charts, breaking down the day's trading from a technical perspective, and most importantly, connecting the short term of today with the long-term trends that we should be aware of. And today, as I mentioned, back to more to distribution. Again, as we've talked about many, many times, the markets move in expectations, right? It's not about what has happened. It's always a forward-looking idea of where things could be headed or where people expect things to be headed. It's all about expectations. And so I think that's one of the values of looking at things visually, is trying to anticipate and trying to, visually see where the trends are evolving and understand where the expectations are moving. Today felt more like a rotation back towards the reality of where we're at and where we may be headed here as we attempt to recover from the conditions we've been in. We'll get to that from a technical perspective shortly. I do want to point out all the things coming up on StockCharts TV and on this show. We have a great guest today, as I mentioned in the introduction. Trevor Neil has been a friend for a number of years and a really, really capable analyst. Tomorrow we have Willie Delwich, who's the chief strategist at Robert W. Baird. Next week, we have some great guests as well. JC Peretz joining us on the 21st. On the 22nd, Jeff Huge joining us from Minnesota. Did want to point out a couple other things. We unveiled the first of our two-part series called The Big Board, Behind the Scenes at the NYSE. That ran today at 11:30 Eastern. Tomorrow, if you tune into StockCharts TV right at 11 a.m. Eastern, you're going to see that first part again, and then we'll unveil the second part right after at 11:30 Eastern. So if you start watching at 11, you get the whole package, the whole sandwich, all in 1 hour. Also, we'll post all of those on our YouTube channel, and you're welcome to check them out. Next Monday, by the way, Behind the Charts, our interview style program. We spent some time at Elliott Wave International outside of Atlanta a little while ago. Sat down with Steve Hochberg and Peter Kendall. Really cool conversation about how they approach the markets using social mood, Elliott Wave, etc. So a lot of great content coming up on StockCharts TV. Getting to our market recap today, as I've mentioned now a couple of times, yesterday and the day before, we're sort of in a bit of rally mode, sort of this bear market rally, and it kept pressing higher. Yesterday in particular, we closed really in a position of strength. The last 30 minutes was strong. We finished near the highs of the day, and it certainly felt like there's this momentum building for the short-term bullish argument, which obviously has been in play for a little while now, a month plus. But today is sort of a digestion of what's happened. Now, we've got a lot of things happening, right? We've got, the airlines announcing the bailout package that hit after hours yesterday. So a lot of the airlines popped up very quickly on that news. But you also have banks reporting earnings this week, and a lot of recognition of the impact of a lot of the shutdown on companies and in particular in the bank. So we're going to have this weird juxtaposition of great news, feeling like everything's all better, and then back to reality, recognizing the severity of it. And again, I think, in the short term, it's been said the market's a voting mechanism. In the long term, it's a weighing mechanism, meaning eventually things get to their fundamental values. But in the short term, it's a popularity contest, and it's where people are voting. And I tell you what, looking at the charts now is the most important way to understand that voting mechanism, understand how people are reacting. So today with the distribution, again, we rallied a little bit into the afternoon, but came back down, finished about midway through for the day, but overall finished down about 2.2% on the S&P, down to 2783. The mid cap index down a little more. Small caps down almost 5%. So the S&P 600 almost finished near the lows, down almost 5% to the day. So certainly more of a follow-through day to the downside for small caps. It was interesting to note that even though large caps, you look at the S&P yesterday, you can see it finished in a position of strength. But look at that same day on the small caps, and you can see where this divergence, right? It was more of a flight to safety type of trade. It wasn't really like a step on the accelerator. So I'm not surprised that small caps led the way lower today as we digested the gains. Today's sell-off pushed the VIX back up above 40, now almost to 41, but still obviously much lower than it was at the beginning of the sell-off. Bonds had a pretty decent day, jumping up out of the open, continuing strong with the TLT up about 2.7%. That put the 10-year yield down to about 64 basis points. And down over in commodities, gold actually sold off in the morning, but rallied more in the afternoon. Still finished down about 40 basis points, but still finishing a lot stronger than stocks. You had this divergence with stocks going lower, and sort of the perceived safe haven of gold rallying. So what does that do to the chart of the S&P 500? We'll refresh this for the close, and as we've talked about again for a number of weeks now, this congestion area, this supply area. We talked with my guest Brian Shannon yesterday about this area, right? The bear market rally has been significant. It's been extreme. We've recovered 50% of the sell-off from February to March. The question now is, now what, right? Where do we go? And at some point, where do we recognize that this is a deeper bear market, or where do we recognize the bear market is over and the market's going to rally? And I feel like we're right at that point where you start to get that indication of where things might be headed. But again, that 2820 to 2860 range, that's sort of this blue highlighted box. It lines up with the August and September, October lows from last year. Also, that first sell-off in February, I think that's why it's so interesting. We rebounded right to that low from last October. So I think we're right at that point where we'll have to see what happens from here. So really key level to pay attention to. Let's look at some of the other themes that emerge at a sector level. Healthcare, all the 11 sectors down. Healthcare down the least, down about 0.5%. Communication services down about 1%. Then consumer staples down 1.6%. Technology was actually down 2%. So, about the same as the market, a little bit less, but over pretty much a market performer here today. The big drags on performance were really in three sectors. You had energy down almost 5%, materials down significantly, and then financial stocks down. Again, that's where you have a lot of earnings this week, so not surprising to see a lot of weakness in financials based on what's been coming out here. As I reminded you, or as I pointed out yesterday, Newmont Mining had a very quick visit to the top ranked scooter trophy, and then got away from that and gave it to AMD. So it's back in technology in the semiconductor space. But again, the top 10 stocks haven't changed a ton. And it's some names you certainly are probably familiar with. Amazon going to new highs, Netflix going to new highs. So it's interesting that some of these stocks, even in a situation where very few are making new highs, a couple of them are these big, huge cap names that are certainly going to drive the benchmarks higher. So you think about the drag that some of those other stocks have done, have had to pull the market lower when stocks like that are actually finishing stronger. In terms of industry groups and themes, there were just a handful that were up, and it's always interesting to see on a big down day which stocks actually managed to finish on the upside. The toys group actually broke to new swing highs here, continuing this sort of consistent uptrend. So it's actually an interesting group to take a look at if you haven't. Stocks that are groups that are up in a decent way at the time when the market is down in a decent way is pretty interesting. Other groups that also fit that bill of up and a down day: healthcare providers, broadline retailers, that's within consumer discretionary, non-durable household products, and then a couple that were flat, trucking and automobiles as well. In terms of groups that pushed us lower, coal is a rounding error of a group, so I usually will skip that one. But you have some real estate. This is the retail REITs groups that has exposure to mall traffic type of names. Also, these are the groups within materials: steel, aluminum. This speaks to sort of industrial metals and demand there. Furnishing groups. You see a mix of sectors that are represented, but a lot of materials, a couple of real estate groups, and media, which is a tough one as well. Media agencies that was on the bottom 10 list. We're going to spend a little bit of time on breadth later, so I don't want to get too deep into breadth characteristics, but I did want to just highlight one chart before we go further. And that was, where are we at? This one, so as we're thinking about sector rotation, I'm looking at consumer discretionary versus consumer staples. This chart we love to refer to because it speaks to the rotation between offense and defense within consumer. And even though we're in, quote unquote, bear market rally mode, and I tell you what, anytime I confuse the words bull and bear, my wife, Mrs. Keller, is listening. She'll point out very quickly. So I try so hard to not mess that up, but it happens. In a bear market rally, I think it's worth noting that you haven't gotten a huge vote of confidence from consumer. It's not like there's been a big rotation out of the defensive side into the offensive side, meaning out of staples and into consumer discretionary. Here we're looking at the equal rated ratio of consumer discretionary versus consumer staples. The last month has actually been more about consolidation. So while, the market sold off, and then it feels like, a lot of people are speculating, boy, this is great. This is a rally. The Fed's going to bail us out of anything. We should be fine here. We haven't gotten that recovery signal from consumer. It's been more of this is a pause that refreshes before the next thing happens. We're sort of still in wait and see mode. So interesting to note that you haven't had a real directional clear signal, I think, from consumer. It's still sort of in a sideways, a coil pattern of sorts. So that's our market recap for today. And again, so many themes, so many charts that we could look at with that. I hope this show serves as the beginning of your process and encourages you to look through some other individual stock charts, especially to see what sort of patterns emerge in your own work. We're going to move on to our next segment, though, which is called Banking on Breadth. And what we love to do occasionally is look particularly at breadth characteristics. And again, if you're not familiar with it, breadth tells you this: if the overall market is doing a certain thing, what sort of stocks are participating in that? Is the average stock agreeing with the broad index? Or to put another way, how many stocks are agreeing with the index? If the market's going higher, what percent of stocks are also going higher, right? Is it a small, narrow group that's driving it? Is it a broader, deeper slice of the equity market? Is it certain sectors? And breadth characteristics can help you answer a lot of those questions. There are a number of different ways to look at breadth. So we like to take our breadth chart list and kind of go through it. If you've not seen this, basically, just so you know, and I don't have it set up on my login because I created them, but there are a series of chart lists that when you create a new StockCharts login, you're going to get what's called the DK morning coffee routine. And it actually goes through and sets up all these charts in your login already. If you've had your account for a while or you don't know how to get to it, it's no problem. Click on the articles tab, go to my blog, and if you click on the drop down, it's called the Mindful Investor. And right at the nope, that's actually not where you find it. Hold on a second. You got to go. My bad. Let's see. We go to your dashboard. We go down here to chart lists. And then I have a ton of chart lists. If you go to the bottom of your list, which is probably a lot shorter, you will see this guy, Manage Chart Packs. And if you click on that, you will see this one right here, David Keller's Morning Coffee Routine Chart Pack. Just hit install. It's free. It'll go right into your login. It's 15 lists of charts, including this one we're going to look at together called the Breadth Indicators chart list. So let's get to some of the charts here. We're going to start out looking at breadth in the form of percent of stocks above their 200-day moving average. And I look at it in two ways. This is the NYSE on the top, and this is the S&P 500 at the bottom. So what's interesting is this. A couple observations. Number one, we had a really clear bearish divergence as the market went to new highs in February. And I will tell you, it was really hard at this moment to think of this as a bearish divergence because I feel like we'd had so many false signals, so many, the market moving higher, just ignoring divergences as the market just was so resilient. But looking back now, it seems completely obvious that you had this lower peak in all the breadth measures with a higher peak in stocks. And certainly we saw this. And then the follow through to the downside, breaking through the swing low is what really validated that downtrend. But look at what's happened since then, right? So these indicators all got very bombed out. So in the previous pullbacks back in 2018 at the low, back in 2015 and 16, the indicator went to about 20% or a little below that back here. On 2018, it got down almost to right at 10%. We went even below that. And I think that signal was one of the things that suggested to me and others looking at a chart like this feels like a deeper breadth move. This is more of a broader decline that has legs, that has more downside. And it would logically line up with some previous really beaten down periods. So for me, going to chart number 2, lines up a little more with like 2008, right? So that initial big sell-off, it had been selling off for about 8 to 10 months before it really fell off a cliff. And that big, steep sell-off in 2008, as we recognized what was going on, as the sort of financial crisis evolving in front of everybody. the indicator got almost to zero and remained that low for quite a while, actually for about 6 months. So once we got to that low, I'm thinking, wow, this is very rare we actually get down there. This feels like it's more like a 2008, 2009 period. What's happened since then is we've diverged a little bit. So it doesn't look like these previous bull market pullbacks, but now it looks a little less like 2008 because we've recovered so much. It's now 23% of the S&P is above its 200-day. That's up from like 3%. So 20% or so of stocks were below their 200-day have now reclaimed it to the upside. And here looking at the 50-day, now almost a third of S&P stocks are above their 50-day, and it was literally 0% that were above it a couple weeks ago. So after an unprecedented decline in the stock market, we've had an unprecedented decline in the breadth characteristics, and now an unprecedented rally, as well as an unprecedented rally in the breadth characteristics. Now I'm saying unprecedented in terms of recent history that most of us have been investing in. There are historical parallels that start to show that this sort of thing can happen. And that's why I think we're now in a period of very minimal number of observations that are directly related to what's happening right now. The next breadth indicator I wanted to look at was the stocks advancing and declining every day. So this is simply looking at 90% up days, 90% down days. When are 9 out of 10 stocks closing up on the day or closing down on the day? Earlier in the day, this was above 90%. It was about 91 or 92%. If I remember that. As we got to the close, it went a little below there. In general, the idea here is a cluster of 90% up days tends to be very positive. A cluster of 90% down days seems to be pretty negative, and that thrust, that breadth thrust of so many stocks finishing on one side or the other can be pretty significant. We did not quite get a 90% down day today. As of the close, things sort of recovered a little bit. This is one we've talked about before recently. Might have looked at this yesterday as I'm thinking about it. This is stocks making new 52-week highs and new 52-week lows. So we have stocks like Netflix, like Newmont Mining, like Amazon, like Regeneron that are at or near 52-week highs, really, closing to new highs, really impressive runs. But it's worth pointing out that that is very much a rarity, right? As much as we've recovered about 50% of the sell-off from February to March, but there are very few stocks that are at new 52-week highs that are really breaking to new highs. And until we get that sort of pattern, you still have to feel like stocks are in recovery mode. They're sort of in digestion mode, sort of backing and filling mode until they're able to get to the new highs. It hasn't happened yet. This one is looking at breadth by cap tiers. I actually didn't color code this. I changed it and I forgot to save it on this thing. I actually changed these color codes to green on the breadth readings because if you look at the S&P, you look at the mid cap, you look at the small cap, they're all actually in a sequence of higher highs and higher lows. So again, thinking of it from a short-term perspective, you're getting the breadth support from cumulative advanced decliners, looking overall at how that's emerging day to day. So that's actually fairly encouraging, again, from a short-term perspective. I did want to just rotate one more to go here, the McClellan oscillator. So the last breadth chart we'll show you is the McClellan oscillator. This is using the advanced decliners. It takes exponential moving averages of the advancers and decliners to calculate this breadth reading. And if you're not familiar with that, look at the Chart School article on the McClellan oscillator. But overall, it's actually been in a fairly positive condition. Again, if you're looking for if and when a bear market rally starts to change, you look for when the McClellan oscillator breaks below zero. At this point, it's well above it because of the strength of this rally. Really not suggesting a rollover just yet. That's our walk through breadth characteristics using our segment, Banking on Breadth. We'll take a quick commercial break. We'll be back with my guest, Trevor Neil from the Betagroup. See you in a minute.
Hi, I'm Julius the Campanar.
And I'm Arthur Hill, and you're watching SCC TV.
Hello, everyone. Welcome back to the show. Thanks for joining us every weekday after the close to break down the price action from a technical perspective. You can get your questions to us at any time. The final bar at StockCharts.com is the best way to get a hold of us. As a reminder, we're here to help you navigate these markets with questions on technical analysis, on market activity, on specific charts, whatever. We're happy to answer your questions the best we can. Or you can look us up on Twitter anytime at FinalBarSCTV. I want to bring on my next guest now, Trevor Neil from the Betagroup. I've known Trevor for a number of years, a former Bloomberg colleagues, and have enjoyed connecting with him regularly and over the many years to get his take on things. Trevor, welcome back to the show.
It's a great pleasure, David. Good to join you.
So you sent a chart ahead of time. We were looking at the S&P, and we've talked on the show so far just about, where we're at, right? This long-term trend and the bear market rally and this question of what's next. So using the long-term view, using the weekly chart, can you walk us through your perspective here?
Yes, I mean, the question we're trying to answer, all of us, is this a V-shaped bottom, and are we on our way up? Is it a U-shaped bottom? In other words, we're going to congest a little bit further, or is it just a rally and we're ready to make another leg into new lows? So that's what we're all faced with here. So as a technician, I just have to look at what I can see and what the market is saying. What are people doing? So we have retraced pretty well everywhere around 50% of the fall. Some things have done better than others, and some have lagged behind, but essentially we've pulled back 50%, which is quite often an area where we can stop and then leg lower. Breaking it is very, very encouraging indeed. But at this very moment, with that candle there, we've got a very indecisive picture. So just looking at the chart, we've come up to some resistance, historic resistance, which builds from here up to 3,000. And so we've touched that, the 50% has touched that. The candle itself is a doji star. So we've got a shadow above and below, open and close the same. I know we haven't finished the week yet, but at this moment, if we were to finish the week like this, we're opening and closing where we started in the week. This candle is a diagram of indecision. It follows the previous candle, which was a diagram of conviction. And so we strongly believe we were going up. Now the mood has changed to indecision. That's a picture of indecision. So after retracing the 50%, we've become indecisive. Now, what else can we say as technicians? One of the things that we look at is the sort of behavioral aspect of how people react to news. We've had some very bad fundamental data. I'm told it's very bad fundamental data, but the market itself doesn't seem to be particularly bothered about it. When we do get good data from a low base, it seems that people are quite keen to take on some risks. So it's a pretty mixed message there, the reaction to good and bad news. The indicators down below on the chart, the RSI, of course, went very, very deeply oversold, as you would imagine. Started to come up now. Mine's reading 45 on here, so pretty well close to the middle, so recovered the oversold condition, testing the downtrend line off that bearish divergence that Dave was talking about earlier that we'd seen, and into the high, and now we're testing that downtrend line. We could break it, and that could be the signal that we're on our way up, or we could make a third point on the line and we could be on our way down. So this is a pivotal moment as far as the RSI, weekly RSI is concerned. Below us, we've got the MACD. This is still negative here. This is, of course, a rather lagging and slow indicator made of moving averages, but it's got some loss of downside momentum, but it hasn't crossed, and it wouldn't cross until we were a lot higher. So the momentum and breadth, David was talking about the breadth. I read that my reading of the breadth indicators is that coming from these very, very low readings, coming up very strongly, as you were pointing out, historically has often led to consolidations. So that could be an indication that we're going to go into that more U-shaped bottom, and so we certainly will need some more time to sort that out. The risk-off measures that I use, the volatility and beta measurements that I use, they also indicate that the market is had its bounce and is ready to pause. The 50 and 200-day moving averages, of course, are bearish. We've got the chart resistance, as I mentioned. So of the three outcomes that we're likely to have, I think that the most likely is that we're going to consolidate below the considerable resistance that is above us here and be choppy, and we'll go into a period of churning and choppiness. So I think that we will not continue this rally strongly, and we will not leg lower to new lows, but make this volatile churning behavior. That's what the technicals are telling me. But of course, as you know, every day and every week is a new bar, a new piece of information, and of course,
In
it
some
can all
cases,
change.
dramatic new information, I feel like these days, right, with all the
Yeah.
volatility. We only have 30 seconds left, Trevor, but I'd love to know, so, I think what you're saying makes a ton of sense. I mean, there's so many reasons why it feels like we're sort of at that level where you'd certainly expect backing and filling or a new down leg or something. Is there something you would see that would tell you that that's not playing out? What would be the signal that, oh my gosh, this rally is, I mean, I know going to back to previous highs seems outrageous to you probably, and it does to me as well. But is there a level at which you would have to really consider a bearish thesis or think, yes, this has to be further upside? Is there a certain level or a signal? Is it
Yes, I mean,
MACD turning up? What would it be for you?
yes, in the short term, breaking this week's high, for example, takes us further up, deeper into the resistance, and particularly how it looks as it does that. If it gains conviction, which would be more white candles, more strength in the candles as it goes up, then I would say this is gaining power as it meets the resistance, and therefore it's likely to push through it. So we are a long way from the highs, that's true, but it depends. If we do go up, how we approach those highs, and if we approach those highs with more power, this would be shown from a technical perspective of long white bodies, Bollinger Bands expanding, increasing volume. People are really buying it. Much improvement in the breadth. All these sort of things would make me think that we're going to make it through the resistance and go through the 3,000 level and attack the high itself. It could happen. Definitely could happen. And it would start from breaking through this week's high.
That's right. Great comments, Trevor. It's a beautiful chart. And thanks for walking us through this perspective using the weekly candles of the S&P. And thanks for coming on the show. Stay safe, and we'll hope to have you on again soon, all right?
It'd be my pleasure. Thank you very much indeed, everybody.
Folks, that was Trevor Neil from the Betagroup based in the United Kingdom. And, he actually phrased it as the candles describing the conviction level, which I don't know if I've ever heard that before. I love that. I will borrow that gladly from Trevor and credit him immensely for that contribution. I like that. And I had not really thought about the weekly candle being a doji at this point. It's actually kind of an interesting way to think about it. We need to move on though, folks, and wrap the show with the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the financial sector. So, when I'm thinking about this week, I'm thinking about that juxtaposition of encouraging headlines and thoughts of recovery, the light at the end of the tunnel, but then the reality that's setting in as companies are reporting earnings and the challenges that are still left to face. And I think a chart of the XLF kind of represents that pretty well. You have this nice counter trend rally, this uptrend of higher highs and higher lows after the huge down move in February into mid-March. Today and yesterday have sort of pushed us lower. The last couple bars actually have all been weaker rather than stronger. And now I think that lower end of this bear flag would be pretty significant. The XLF notably making new relative lows today versus the S&P 500. Chart number 2 is looking at the VIX. And when you think about volatility, I know a lot of discussion, at least I've heard, is how low the VIX is relative to where it was. It was up above 80, and now it's almost at 40, or it's a little around 40 today. It's halved. Doesn't that mean that things are better? I would point out, though, that we are still above levels like the 2015 low, the 2018 low. All of those were actually below the current levels, and the sell-offs in 2010, 2011, a little above it, but still within the 40 handle. So even though we've come down a lot, totally fair, we can turn right back and go to new peaks anytime. There's no guarantee on that with the volatility. And finally, just a reminder, as we're thinking about the recovery themes and thinking about what charts to watch, Microsoft is a really compelling one to watch. And I'm seeing a stock almost making new relative highs. It's pulled back a little bit, didn't quite get back up there today, but outperformed the market by about 100 basis points. Back above 2 upward sloping moving averages, which is better than I can say for most stocks out there. So I'm looking at stocks like Microsoft as testing previous resistance, but the RSI right at 60. And I think that's always a key one to watch to decide whether something's recovering or not. Folks, that's our show for today. I want to thank my guest, Trevor Neil, joining us from the Betagroup in the United Kingdom today, staying up late to share his perspective. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.